Well, hello and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations or outlook. And it's basically a special report. We're going to discuss all of the headlines that we've seen in the economy. I'll go through some charts, sort of where we have been, but more importantly, look at the market internals. There's been a lot of obviously volatility and structural damage, if you will, to some of the indices. What does that tell us? Where are we? And historically, we'll put some historical context and put that into perspective for all of us. And if you've seen us before, we usually do quarterly updates. This is a video webinar that we produce by Blanke Schein Wealth Management, and you can we'll have this available. If you can't stay for the entire, we'll send out a link, or if later on we'll send it to our clients as well, friends and family, anybody who could benefit. Please share this. But let's get right into it. And let me see if I can run the show. Look at that. This is the first time that I'm in control. Usually the control center's in control. So this is a lot riding on me today, running the Zoom from start to finish. This is impressive here. All right, so today we're going to do a lot of FAQs, frequently asked questions, what to watch. And quite frankly, obviously the markets have had a lot of volatility. We've seen the question is, we're going to talk about earnings today, the Federal Reserve, inflation, and the U.S. consumer. We'll also touch on geopolitical events and historical market outlooks and what to expect in terms of what sectors look attractive. Number 4 is another question that clients ask: are we going to hit a recession? Are we in recession? And where are we with regards to that? And what should investors be looking for over the next, I wouldn't even say 6 months, I'd say 3 months to take a look. And you could always follow along this afternoon. I've got a lot of press this Friday. I'm with Liz Clayman and Fox Business. We'll send that link out. It's closing countdown, Clayman countdown, 1 o'clock, basically 12:50 Pacific Standard Time. And then I have Yahoo at 1 o'clock today. So we always aim to have our sort of thought leadership out there for our clients. And also, you could also subscribe to our YouTube channel, and that provides video updates, market insights and observations, or any special reports that we're doing. That's at Blanke Schein Wealth Management and YouTube. If you had the ability to join us this last February, we had the 2025 Confidence Summit, Women, Wealth, and Wellness. We're going to host it again in 2026. If you have some interest, please drop us a note, an email, or let us know. We'd love to have you. And if you're a Blanke Schein Wealth Management client, you're hosted by us. But this last year, we had Stephanie Link, who is our chief investment strategist at HighTower. And Stephanie was just fantastic. We've got video recordings of that if you want to see that whole run of show. We also have our few podcasts where I bring in women entrepreneurs, business leaders, and civic leaders within the community. And we talk about items that are and issues that are, 1, learning about their story, but 2, inspiration from not only financial literacy, but education and inspiration. We just had some great podcasts that we just filmed the other day as well, but check it out. It's on YouTube. And then the HighTower story. If you know about HighTower and our firm's growing substantially. We're just about in every state in the United States, 144 teams, and we're the Palm Desert team. We are an accredited investment fiduciary. So Rick and I have that designation that puts us basically in the same legal obligation as a CPA or an attorney versus our previous life where it was a suitability. Suitability is basically saying, hey, listen, when this investment is in your portfolio at that date and time that's suitable for you based upon your current life situation, then it's good to go. Conversely, the fiduciary, not only is that moment in time, that investment in your portfolio, but we monitor it all the years, whether that's our requirement to make certain that not only that date and time was it suitable, but is it from a fiduciary standpoint, our oversight. So we're constantly monitoring our client portfolios and staying in touch with our clients, making certain that we're in touch with their current situation, life, their goals, and their feelings as well, and also have constant communication, such as this today in this webinar. And again, we're in the world of retirement. We understand that retirees, want to retire in a worry-free retirement environment, and they want to just pay us to worry essentially, and stay retired and have their money grow protected, and but grow and stay ahead of pace of inflation so that they get pay raises all the years of in retirement. But we always say that it's not only just the investments, this is the 5-step comprehensive wealth management experience that we take a look at when we do the financial plan for our clients. And the real goal is not just the investments that provides the income and the lifestyle that everyone's seeking, but more importantly, we take a holistic approach to wealth management, and we take a look at the sort of the healthcare, making certain that whether you have long-term care or you self-insured or you have the proper documents as it relates to your estate planning. And then again, on the other side is the legacy. Are your estate planning documents up to date? Have we done a beneficiary review? Do you have outside assets or outside accounts that you'd like us to review, even consolidate and bring in, so it's easier for us to monitor and it's easier for you? And then obviously life insurance and charity planning. But if you don't look at the legacy planning from the estate planning side and making certain that that's reviewed, or the healthcare, that could, and we've seen this before, completely wipe out sort of the plan, if you will. So those are more important. That's why we have to take a look at a holistic approach. Everyone knows that we have the true retirement experience. We start with the financial plan. We're deep into education, as well as the guidance, the investment process, and as well as the service. Here is, every single one of our clients has a financial plan. If you haven't had a financial plan updated recently, we encourage you to reach out. We try to do that on a proactive basis on our side as well. Or if you're thinking about, let's say, I want to buy a second home, or I want to relocate, or I want to go a trip around the world, whatever it is, we encourage you to reach out to us at the advisory level here at Blanke Schein Wealth Management, and have us model that for you before you do it. We like to measure twice, cut once, and make certain that, financially speaking, we're being smart about what pocket we take it out of. And we're being also tax conscious. So we're doing smart on the tax side. So we can model all that for you. So if you have anything that comes your way, or you just want to get a checkup, we're happy to update your financial plan. Again, we have the estate planning, insurance, as we discussed, and all the other wealth solution services, trust services, and so on and so forth. So this is our disclaimer to make all of our attorneys happy. Take some time and read it, and let's get into it. So if you've seen a webinar that we produced before, I've had this slide for probably 3-4 years. And I've traded out some images, if you will, obviously the trade wars right now. But the reality of the situation is that yes, today the headlines are crazy, but that's always the case. Wall Street climbs a wall of worry. And here are the headlines. Obviously, chaotic tariff regime and trade wars are leaving small businesses in the wake. And that's a big concern. We'll talk about that, because small businesses are 80% of basically the employment. They employ 80% of the US labor force. So if there's uncertainty in the labor force or on the small business owner, he may have to lay off, or he may not hire. So that's very impactful to the economy. The Trump tariffs, the White House is considering, this is last 24 hours, I just put this one together, slashing tariffs with China, and they hint on the de-escalation. President Trump was just asked in the last 24 hours, 150 or 65%, whatever they are right now with China, is that going to be there? And he's like, that's too high. Is it going to be lower than where we are right now? Yes, probably. Is it going to be at zero? Nope, that's what he said. It's not going to be at zero. So somewhere in the middle, we'll land there. We'll talk about that. And then another headline that has disrupted the market significantly, and Trump reversed that. Basically, he put out a tweet saying he needs to, we want to replace or remove, or even, sort of threatening the Federal Reserve Chairman's position, saying we could replace him. And now he is reversing that, or at least clarifying, saying he has no intention of firing the Federal Reserve Chairman, Jerome Powell, which is actually welcome news today. The market's up on the heels of that. Now, mind you, it doesn't matter. I always like to show this. First Trust has a great piece here that shows sort of historical context. And we use this in the 2024 election, even prior to the election itself, because there still was the unknown at that moment in time. And essentially, you see on the bottom there, on the axis there, you see the red. If you invested $10,000 over the course of since going back to 1949, so 1950, the growth of that $10,000. If you said, I'm only going to invest when a Republican is in the White House because I'm Republican, or that's your belief, well, you could see quite clearly you've missed out on significant returns of what the market has produced over that last 50 plus years. Conversely, if you did the same as a Democrat was in the White House, you did better than the Republicans. So Democrats have provided a little bit more under their administration and leadership in terms of market returns. But you really can't play the game of red or blue. Our clients look to us to say, hey, listen, let's have a level headed and level set. And they're looking to us for green. So if you basically invested through all of that past 50, 60 years, you could see there it's clearly just under about $3.5 million versus not even 200,000 on each side. So let's not have politics play into this. We want to stay clearly focused on what we should be focused on. And here are the keys for 2025. Going into a pro-growth Washington policy, this is start of the new year. The U.S. policy changes. They're looking at tax, fiscal, and regulatory reform, and we'll talk more about that. Another positive shoot for 2025, and we're still seeing this play out, is the S&P earnings are broadening out. What does that mean, Rob? Well, essentially, the last few years, the bulk of the earnings that we've been seeing have been from the tech sector. There's 11 sectors of the S&P 500. There's technology, financial, healthcare, discretionary, so on and so forth, industrials all the way down. But majority of the earnings have come from technology. In order for the market to continue higher, technology has now taken a back seat in terms of earnings. They're still growing, but other sectors are now growing even faster than in terms of earnings perspective relative to technology. So as the market broadens out, meaning all the other sectors are doing better, which they still are. We're seeing reports every night as companies report in other sectors that are doing better. So that's still a positive. I want to play that out and make certain that that's top of mind. Number three, the AI needs to deliver. There's a lot of technological opportunity sets here with regards to artificial intelligence, and I think we're just at the very beginning, scratching the surface. So not only on the investment opportunity, but what it means to S&P 500 or all the companies for efficiencies moving forward, and that's a huge driver again to earnings, not only in the short term, but as they scale and they integrate AI longer term. So it's another positive. Number four, there's opportunity for fixed income. So as we see interest rates are coming down a little bit, obviously we see in a roller coaster and a ride this year. As interest rates come down, bond prices go up. So there's appreciation in the bond market. So we believe interest rates in the back half of the year will come down. We think there's justification for it. And then if that happens, that means that anything that we own in the fixed income space will appreciate, but also pay us income at the same time. So that's an exciting opportunity for fixed income. I would say now we have fixed income looking sexy again. And that's because it's a joke because fixed income is always boring. But we could see a little appreciation plus the income. And this should be number five, but it says number six. It's got 5 and 6 together. You have Fed policy and inflation, as well as the labor market. This Friday, we're also going to get a labor market update. So that's very important because the Federal Reserve is paying attention to that. And we'll discuss what that means. Now, again, this is a great First Trust historical perspective of the long-term average of the S&P 500 index is basically, in this case, from point to point, going back to 1970, just for this historical perspective, the return on the S&P is 10.5% on this. Now, we all know that Wall Street climbs a wall of worry. So what you see here, and don't worry about focusing in on too closely, but everything that's highlighted are essentially the biggest and worst things that happened in that calendar year over time. Meaning, we have 2007 or 2008, the great financial crisis in there. We have obviously 9/11 in there. And so you're seeing historically, going all the way back even to the 70s, Wall Street climbs a wall of worry. And it's always important that even though there's crisis and events, the market grinds higher. And that's because corporations continue to make, basically produce, and that equates to earnings over time, and innovate as well. We've got the most innovative US economy and global economy here in the world. And this is important this is another slide that I want you to take a look at. The current bull market is still relatively young. And yes, we're still in a bull market, even though the market pulled back. We didn't close down 20%. We touched it earlier by S&P 500. But essentially, since 2022, the most recent reset, we're about 26, 27 months of a bull market. The average bull market in terms of months over time is 67 months on average. And if you could see that gray bar, that's kind of what we're in, the space that we're in today, relative to the bull markets of previous. There's potential for the bull market to continue. But yeah, right now, and this is another historical perspective of the bears and bulls. Just keep in mind, the bears come in fierce and fast and have huge volatile drawdowns quickly, and then we grind our way back. But the bulls, historically speaking, are a lot longer and produce a lot. So the average bull market period is about 4.2 years on average, with a cumulative return of 147%. The average bear market lasts about 11 months, with the average loss around 31% cumulative over that period of time. And it's never fun going through a bear market. Again, we're not in a bear market. Technicals have tested that right now. We haven't essentially closed there. We're still in a bull market. So that just means that, and it's not uncommon for the S&P 500 to draw down during the intra-year declines. I mean, we see that every single year. What this chart is showing is a historical performance, and more importantly, the volatility of what happens in that calendar year. So each one of these years shows where the market finished by way of the return. So as an example, in 2023, the stock market, as measured by the S&P 500, all the way in the far right, as you're looking at this, it was up 12%. But we were down 8% intra-year. Some point in time, the market was down. The previous year in 22, the market was down 19%, but it was down 25% throughout that calendar year. If we even go back to 2020, if you remember, we were down 34% intra-year. That was probably March of 2020 as well as April of 2020. We retested, but we ended up 16% that year. So this puts a historical context that it's not uncommon to have a drawdown of 10% at least. But more importantly, it's not feast or famine. This is the S&P 500, and this shows the statistical index and how it's basically grouped together of what return it's had since 1926. So we tend to be more positive. We have a lot more positive years than negative years. And again, the S&P 500 under this context has essentially averaged 10%, as we've said before. Now, if we look at this sample set, the total years in this is 97 years. The positive years are basically 73% or 71 out of the 97 years. Negative 26 or 27%. And then the number of years, this is interesting, where there's been 20% higher gains or greater, 35 of the 97. So what that means is, if you look at that green bar all the way to the right, is exactly what I was pointing out, that markets tend to really group together in bull markets. And if you look all the way to the left, the worst years that are 20% down, where the market ended down on a calendar return, 20% or greater, where it's going back to 2008, 2002, and then in the 70s, and then you have the Great Depression. So we're not in that camp, especially where the strength of the U.S. economy and earnings are coming in. But yeah, it kind of feels like, hey, gosh, if we were to stop today and look at where the market is, we could be down. But again, it's not uncommon for the market to be down during the intercalendar year. But what's also interesting here is this blue column, is that even though the market over time has yield about a 10% average annualized return, there's only been one, two, three, four, five, 6 times where it's actually been in that 10% range between 8 and 12%. And that's what that's showing. So visually, you have to have, you have to basically stay in it, have a long-term perspective. And, how are we preparing our clients? Well, we strategically rebalanced. We put some cash and treasuries in our client portfolios at the very beginning of this year. We always carry cash, and cash is a great opportunity. The cash that we have is paying, it's paying our clients the 4.5%, which is great. But our process is very important. We are balanced and diversified. We call it the art of asset allocation. And I think you've heard all of us talk about that many, many times. Number two, we are managing the downside risk, which means winning by not losing. So if we balance our portfolio and diversify our portfolio, we dampen the volatility. So we don't come down as much as the market. In fact, our portfolios are doing very well and being very resilient based upon all the volatility that we're seeing. And if you don't go down as much, then you don't have to recover as much to basically get back to where you were on the upside, which is part of the key of managing wealth. And that's what we've done for 40 plus years. We're going to continue to do that for 40 plus more, because that process works. Number three, we're staying nimble and taking advantage of tactical opportunities. We call it strategic rebalancing. That's what we've been doing, actually, picking up some names that are just leaders in their own sectors, and they will continue. So if we see a discount of a company that's down, great management, great leadership, positioned extremely well in their space, in their space and what they're doing, and all the way around, but it's down 20 to 30%. We're going to start using that cash that we have, that dry powder, if you will, to take advantage of it. And we're doing that. Here's the art of asset allocation I discussed before. I've shown this before, but I want you guys to see it. This goes back, all the years of the market, but essentially it's the last 20 years of the best and worst and how each sector or category finished up. And it's just the art of diversification, essentially. All I really want you to see, don't worry about zooming in, or if you ever want a copy of this, we can send it to you. But MFS produces this, and it's great. It basically essentially says that if you go back to when you were in kindergarten, you have all the crayons in the coloring box, and you take all of them and you start coloring, use all the crayon colors together. When you blend the colors together, you get black. That's part of the art of diversification, a very simplified thought process. At the top, you have the best performing asset class or sector of that calendar year. On the bottom, you have the worst performing. Doesn't mean it was negative that year. It just means that, some of those have done, it was a bull year and everything's done really well. But if you have an average, a little bit in each color, if you will, the crayon analogy I just used, you get black, which is the diversification. If you take a look at the black sort of diversified box on this and go all the way back, you're not at the top, so you don't have to put all your chips in one color or one sector, but you're also not at the bottom. Again, that's the dampening the volatility. That's just a visual representation of the diversification and balance that we do for our clients. Now, diversification is working. In fact, here's the performance in the last few months that we've seen. Obviously, stocks on the left-hand side, small caps, and we have limited exposure for our clients to small company stocks, small caps. Majority, we have large caps if we're if we're exposed to stocks. And this is as of last week. Obviously, we had a couple of great days, so obviously the market's turned around a little bit. But yeah, the stocks are down. That's the bottom line. In the middle, you have cash, you have bonds, you have gold, and then you have even international. International is actually up and working, and we've had international in client portfolios for quite some time, and now it's actually doing well. So all of it together, there are areas, are green shoots in the portfolio, and the diversification is doing its job. Now let's talk about Washington policy and the economic agenda. So Trump's agenda basically are 3 pillars, and the first one was deregulation. And he got that accomplished within the first, few weeks or months, if you will. And next pillar that he's working on right now are tariffs. And finally, he wants to address taxes. Keep in mind, there's the 2017 tax cuts, Trump tax cuts, if you will, that expire, if you will, at the end of this year, 2025. So if Congress doesn't act right now, taxes will go higher across the board for not only individuals but corporations. So Congress has to act right now. In 2017, 2016, Trump he reversed the sequence. He did all of this once before, on his economic agenda. He just reversed he went for taxes first, then he went for tariffs. Keep in mind, he put $300 billion on China during his administration, of which the Biden administration kept the $300 billion on China tariffs because the deficits and the budget Biden couldn't get anything done if he removed the $300 billion of basically fair trade and tariff trade, if you will. So both administrations have had tariffs on China. Trump put them on, Biden kept them in. I think that the challenge that we're having right now is the sequence. Potentially, and time will tell, should Trump have switched these two, meaning passed and get the extension and get some certainty for small business owners, individuals, and the markets, and have the tax bill passed and then go for tariffs. I think the calculus here, though, is that if he could get a lot of money paid for, he can then go to Congress and say, hey, listen, we could do a lot more for the individual and the small business owner because I'm bringing in $1 trillion worth of tariffs, even if it's at 10% across the board. So that's the calculus. We'll see how it plays out. And obviously it's very messy and volatile for the markets. He also said this, and I referenced this earlier, the historical basically context of the president and the Federal Reserve. The Federal Reserve is independent and it has to remain independent, and it can't have political influence, i.e. the President of the United States saying we need to lower interest rates. And oftentimes, and traditionally, the president usually does it in the year before an election or the election year. Why? Because he wants basically free money, if you will, or loosening the opening the spigot and having more liquidity, and that will rise asset prices, if you will, and then make that, that president that's looking to run again, if you will, in better light, because it's very supportive of their economic agenda, and it traditionally would have a positive effect on the stock market. And so obviously Trump is trying to do that with Jerome Powell and jawboning, but it's really out of school, but it isn't out of like the only time it's ever happened. In fact, this is a chart. Strategists put this together, and this is in our morning research, and it shows every single case in point from Truman to Eisenhower to Kennedy, LBJ. In fact, LBJ, Lyndon Johnson, had gallbladder surgery, and he had his ranch, and he called the Federal Reserve Chairman to his ranch. And there's actually photos on the internet of LBJ getting in the face of the Federal Reserve Chairman about that same issue. He wanted him to lower interest rates, and he wouldn't do it. So stuck to his guns and essentially, did lower interest rates, but that invited inflation in. So we'll talk about that. And this goes to second. Ronald Reagan had another exchange with Paul Volcker. Volcker, remember, he had to take the prime rate to 21.5% back in the early 80s, and 84 was hitting an election year. So Reagan wanted to having an intervention with Volcker on interest rates. Volcker didn't cave, and then Reagan still was able to be reelected. But this goes to show, historically speaking, although we see it on a tweet today, Donald Trump is not alone from a president wanting a better economic backdrop by way of interest rates. Now, this is from Bloomberg, as well as the Federal Reserve. This is what Trump said: is the Federal Reserve Chairman Jerome Powell too late? So what the blue line is the Atlanta Fed GDP. And what you're seeing on the far right is that the gross domestic product, basically our economy is right at 2%. This has fallen off from 4% to just under 2% in terms of our growth rate of the economy. So obviously we've had a growth scare by way of all that we've seen in the headlines. Now, the red line is the Fed funds rate. So you're seeing a big divergence about our Fed funds rates at 4.5%, and our growth rate of our US economy is suffering. And that's what Trump is pointing out, saying, hey, wait a minute. Now, keep in mind, the economy's suffering, but also we were just going off on inflation. It's coming down, it's trending in the right direction, but inflation in the last 5 years has been, we're all still feeling it. Every one of us at the kitchen table. So it's still, the Federal Reserve knows that there's still an issue out there. But what does the market say? Well, breaking down the relationship and the measurement of stress in markets, we look to the dollar, and the dollar really is a good basically indication of where yields should be. The dollar has been breaking down. So does that mean that interest rates start falling in unison with the dollar? Historically speaking, it has. You're seeing that yellow line of where interest rates are, and the dollar is the blue line. And so the divergence right now indicates or suggests one of two things: either the dollar, which we're seeing reverse a little bit today, but they have to come together. Historically, they're usually coming together. So does this indicate that 10-year Treasury or interest rates should be coming down based upon the action of the dollar? Time will tell. Now, what are the key takeaways of the tariffs? We've seen this. President Trump initiated on April 2nd the Liberation Day, which sent the markets in a tizzy. On April 9th, he pushed pause, reciprocal tariffs, and basically saying, hey, 90-day, because he saw what was happening, not only to the market, it's not so much the market, it's the psyche of consumer confidence in the consumer and small businesses, and that is the overall economy. And then the volatility cuts both directions. We just saw the last 48 hours, the market's been up 1,000 points, down 1,000 points the day before. Today we had futures gap up, and market is up as we're speaking, but you never know until the end of the day how we close. What we're watching and what we want from a technical perspective, when you basically are, don't have clarity on what the trade tariff talks look like, no one does, even President Trump doesn't. You look to the market damage that's been done from the indices, in this case, the S&P 500 we look at, and we look for key levels of either support or resistance. That kind of gives us a guide to say, hey, wait a minute, is the market oversold? Are we to the point where it's going to start working its way back? And then once it works its way back, what are the, sort of the ceiling or the resistance levels that we have to work through, meaning push through and close above, for confidence to know that the market is in good shape moving forward? Well, right now, the market is, obviously S&P is up in the about a 5,300 level right now, in that range as we're speaking. Support, needless to say, is at that down 20% from the all-time high. So down 20% from the all-time high puts us in a range for the S&P 500 of around, let's call it 4,700. So right now we're at 5,300 for the S&P. We could see potentially another 10% down to touch, and that support level maybe retest, and we'll show you potentially how that could happen. Now on the upside, as we're at the 5,300 level, there is resistance, meaning it has to push through the 55 to 5650 and close above to give us an indication that the bottom is in on the S&P. So there's not 100% certainty that's where we are right now, but we have put the first leg in of testing a market bottom. And so underneath the hood, the market internals are doing the work in a short period of time that we need to see that this is all behind us. We also need to see leadership regime change. We've talked about this, defensive to cyclical, or broadening out essentially. So we're seeing sort of risk on trades. So you could see your Bitcoin moving today, sort of animal spirits on the discretionary side. Those categories of cyclicality showing that we have more risk on moving forward, or those in that basket, if you will, are more sensitive to the U.S. economy. And as those do better, the cyclicals do better, that means that the U.S. economy potentially isn't as bad right now as potentially the market forecasted and predicted. And that actually is a good quality indication. So we have to watch the cyclicals. And they are at least the last 24, 48 hours performing positively. So that is a good indication. The breadth of the market, this is the third pillar, if you will, of market internals. This gets really technical, but it's important to know what we're watching for you to make certain that we're well on our way and getting a lot of this behind us. The breadth is basically the advanced and decline. So how essentially, if you have 500 stocks in the S&P 500, and we use the S&P 500 because it's the 500 largest companies in the U.S., but it's also a great indication of sort of other markets. We know there's NASDAQ, which is a technology. We know there's Dow Jones Industrial Average, which are all the industrials. But the S&P is a broad mix of that, so we use that. So the S&P on an advanced decline on April 9th, when Trump, if you recall, reversed or put a pause on the reciprocal tariffs for 90 days, we saw it's 94-1, basically 95% of those stocks on the S&P 500 all closed up. So it's across the board. You have positive momentum to the upside versus negative onesie twosies. Those could have been single stock earnings reports, so on and so forth. But when the market closes up with that much breadth and strength to the upside, it's extremely positive. Now, here's another indication. Past 100 years, every major market bottom has had a cluster of these days, and they have to be strong. So yesterday we had a cluster of that compared with today. We'll see again but if we see more and more of that, even if we see bigger drawdowns and testing the low, we can see more breadth internally, positive to negative. That means that we're closer to getting out of this and having the market start working its way higher. So the advanced decline, multiple days in a row, is a positive sign. So it's good to see that playing out because we've had 9 weeks of the market decline. Second accumulation signal is what we're talking about, and it's a 2-2 ball game, meaning there's a couple of days where the negatives, we're beating the positives. And as I showed, the April 9th was a 34-1, and April 22nd, 13-1. So you're seeing the S&P work its way through this and really try to come up with some certainty in an uncertain future with regards to tariffs and taxes and so on and so forth. Another indicator that we look at the S&P 500 is the 200-day moving average, and that's really where we have that support around the 4,700 level. Again, we could touch it again, and that would be a healthy sign. It could happen very quickly, but it's a healthy sign. It's one of those where we indicate we touch it and we basically close above it. We don't want to close below it. That just means that the market will start moving forward. And if we could see that happen sooner than later, that's a welcoming sign. But if you can see this, the green highlights all the way through, historically speaking, have shown that once we've done that, touched the 200-day moving average several times in the past, that's a good technical indication that the worst is behind us, and now markets can start working their way higher. We're getting very close to that read, as you can see. And this is another indication of that, just another chart from another news source. So we're paying close attention to that. I know it doesn't feel good and it's never fun, but we've done this in quite a quick fashion and again, this has been self-inflicted. So, earnings haven't been impaired as bad as the market predicts. If we don't get resolution to tariffs, or we don't get resolution, or we don't get the Trump tax cuts passed, let's call it May or June, in a balanced budget, or at least the budget itself, it's working its way through reconciliation right now, and Congress has to get to work. That's when markets start going lower than the 200-day moving average, and that's when something could turn into greater than where we are. I don't believe that's the case, but that would be the risk that we would be paying attention to. As I said before, no two market years are the same. The anatomy of a 10% correction, as we saw, as I showed earlier, all look different. One of the interesting things on our side, Urian Timmer, who is a Fidelity Chief Investment Officer, he's just a great strategist. He put this chart up just yesterday, the day before, and said, listen, is this signs of 1998? If you recall, in 1998, we had long-term capital management. it hit the financial markets. The market was, drew down, and then they retested the low. But the market ended significantly higher, 20+% at the end of that year, 99 and then 2000 even. The market kept going. So the bull market was still intact, but we did have that sort of moment in time where it didn't turn into a recession and it didn't have a lasting impact or negative impact on earnings, and the market was able to recover quite quickly, April and May. The irony is that's kind of right where we are right now, and once we pass that, we get to June, all the rest of the year. We don't know if this is going to repeat itself. Again, no two markets are the same. This is definitely a different place in time, if you will, not only in the economy, but where we are. But it's interesting to take sort of a look historically and say, well, we could see something like that play out. Again, when we have, is the worst over? I already discussed this, and essentially these are all buying signals based upon when you have the New York Stock Exchange, 98% advancers, and the volume is there and it's tremendous. So we've seen, it's rare stuff, and it has always marked a bottom low in 1987, 09, 2011, and 2020. When we see multiple trading days have high conviction, as I said, high volume and high conviction advances to declines, up nearly 25% on average through those last few years, if you will, that I just markets I talked about 6 months later. So hang in there if it's going to play out the same way. And again, this is another way. Charlie Bellio is a great strategist too, and he shows basically a rank of the two biggest percentage declines and forward returns from going back to 1950 to 2025. And so the two biggest percentage declines back to back. Remember, we had earlier on April 4th and 3rd, if you will, on the Trump tax liberation day, we had drawdown of 10% on the S&P 500. If we look at all the others, so that's the fifth worst, if you will, in terms of biggest declines and quickest, and historically speaking. And we've got 2008 on here. We have 1987 on here several times, if you will. But if you go to the right-hand side, all of that is green. What that means is the forward return on the S&P 500 a year from now, 3 years from now, 5 years from now, it all looks pretty good. So this potentially is short-term pain for long-term gain. Again, that's historical. Hopefully that we do follow that same pattern, and that shows that we could see positive returns in the next year, 3 years, and 5 years. Again, this is another same chart, same sort of analog of the markets, who's showing even 2 months later, 100% of the time we have a positive outcome when we see 2 of the last 10 days have seen sort of that violence in the stock market, as we saw in early August or April. This is consumer confidence. Right now, consumer confidence is at this is going back to March of 2022. Consumer confidence, even now in March of 2025, again, is hitting on a same sort of drawdown. We're 56%, 57% right now. We could see that later on Friday. Again, read come out. So I'll be paying attention to that. But those blue dots on the bottom, when the consumer confidence is the worst, the forward returns on the stock market, historically speaking, in the next 12 months, when you have consumer confidence the worst, have been double-digit rate of returns. So what does that look like? Well, that's a pretty good indication of where we are, right? It doesn't feel good. It doesn't feel, confident for anybody, if you will, not only for consumers, but for businesses. But we'll see how this plays out. But from a read of a historical perspective, this has always been a great buying opportunity because you couldn't time it any better, if you will. And that's what that's showing. Now, what's the real issue, and why is the Federal Reserve chairman sticking to his guns? Here's, to me, I think, the bigger risk and the bigger issue. So although we went through the market historical returns, the market internals from a technical perspective, I think we've made a lot of progress there. I think we're making a good progress moving forward. Earnings are still coming in really solid. Earnings reporting in terms of the estimates have come down a little bit, but we still have growth year over year, which is very positive. Again, if we stay with all the uncertainty on tariffs, then I think deals will be made sooner rather than later. I think Trump now sees the urgency based upon the market reaction. But the Federal Reserve chairman is not going to budge. on interest rates, although he might have to because of consumer confidence and all the other stuff that's piling up right now. Historically speaking, inflation is a monetary phenomenon. If you've ever heard of Milton Friedman, he is a great economist, one of the best. And he basically says inflation is the cause of too much money chasing after too few goods and even services, if you will. We saw that post COVID with all that money and then everything shutting down and the supply chain issues and all those dollars chasing everything. That was inflation. And this is one of my best is if you put the federal government in charge of the Sahara Desert, in 5 years, there'll be a shortage of sand. I believe that. So we'll see what Congress does. But essentially, the take home point right here is what Milton Friedman was indicating is inflation is not just a one and done. Sometimes it comes back. And essentially, if you lower interest rates and you allow sort of loose financial conditions and you make everything more affordable and you don't pump the brakes on the economy and then money starts chasing goods and services again, you could incite another basically resurgence of inflation. It's happened historically speaking. I'm going to show it to you in just a minute. And that's where there's that tug of war that's going on because the Federal Reserve Chairman doesn't want to make the same mistake that they did back in the 1970s, where they lowered interest rates. They took off the restrictive policies too quick, too soon. Inflation wasn't anything to be done. It wasn't over. And then it just spiked out of control, out of the Fed's sort of calculus, if you will, back then. Here's where what I like to show, First Trust has a chart that shows, again, essentially dissecting the CPI, the consumer price index, if you will. So the basket of goods and services. And that blue line, don't worry about reading it, I'll read it to you. That blue line is showing the inflation as it reports to hospital services. Year over year, it's double-digit rate of return. The next one's college tuition. Well, that's great for Rob and Jen because we have 3 kids in college right now. And college tuition has been in a double-digit increase every single year, and it hasn't even come down. Then you have medical services. So basically everything that what I call a CPIU, what's important to what you and I spend money on is healthcare, education for me, and most of us, if you will, when we're going through this. But that still has inflation regardless of a recession, regardless of the economy, regardless of whatever. That's why we have to stay invested. That's why we need growth from the stock market, equity sector to grow and keep our purchasing power ahead of the inflation of what you and I spend our dollars on, our kitchen table economics. What always gets me, and it's hilarious, on the bottom of this chart is the deflationary pressures of a TV. You and I both know that when we walk into Costco, the fun thing is you look at all the TVs and you always see a TV. If you purchase one, the next month it's even worse, right? Because it's better technology and it's cheaper price. But you and I don't go out and spend every single day on a TV. What we do is spend every single day on college and hospital and medical services. So it's like you and I, the government sort of has it wrong when said, oh, inflation's coming down. No, why we feel it, whether it's paying at the pump or at the grocery store price of eggs or what we're spending our money on, the dollar doesn't go as far as it used to, even in the last 5 years because of this COVID spending fallout, if you will. And so that's really the inflationary stabilization trick that we're trying to do. And what this shows is that blue line is just showing how inflation still has continued to climb higher. On the line underneath it shows over the last several months, if you will, or even years, inflation has trended lower. And that's where the politicians and the pundits and even the president right now is saying inflation's lower, Federal Reserve Chairman, you can now lower the interest rate. That's really what's playing out right now, but not so fast. I'll use the Joe Biden ice cream analogy. So Joe Biden loves ice cream, President Biden, former President Biden. And at the very beginning of his administration, if you buy a ice cream cone, 1 scoop for $1, that's great. By the end, it was $2 for that same 1 scoop of ice cream. Well, that's why everyone's saying this is ridiculous. How did this happen? How did we get here? Now the new administration's coming in and saying, wait a minute, now that ice cream costs $1.50, so it's come down from $2 to $1.50. So everybody should be happy. The answer is no. because we all remember when the ice cream cone single scoop cost $1. I'm sure most of us, if we go back to thrifty days, it was a quarter and then it was 10 cents and so on and so forth. I mean, we all been there. But the point is that going down from $2 to $1.50 and telling the consumer you're feeling better, you should feel better because it's cheaper. That's not the case. It's not cheaper. It's still more expensive at a quicker and faster rate than most recent history. So that's what's really playing out. Because everyone's saying, oh, it's great out there. No, cost of living is still high. This is the biggest risk to everything right now, is the inflation tends to come in multiple waves, historically speaking. So this is the CPI, what I just described, Consumer Price Index, year over year. And this goes through the last 5, if you will, waves of double-digit inflation. So those years are 1910, 1939, 1972. And then the current is the blue, where we are in the first wave, starting back in 2019. But the question is, do we lower interest rates, making money and monetary policy easing and money cheaper? Does that blue line follow the historical trends of the previous years? And that's where Federal Reserve Chairman is trying to stick to his guns, trying to break the back of inflation, if you will, and try to bring down goods and services down, if you will. And that's really the stalemate and the Old West shooting match that's going on. Now, one could say, did Trump really want to have a self-inflicted wound to injure the economy proactively? I don't know why you would do that, but that would be kind of crazy, right? Then to show and give a cause to and evidence to show that labor is, slowing in terms of hiring, and unemployment's ticking up, and a lot of bad things are happening on the horizon, which is the other mandate of the Federal Reserve saying, hey, wait a minute, the economy's softening. Federal Reserve Chairman, now you have cover because you have a dual mandate, inflation and labor in the U.S. economy. So we will see. We'll pay close attention to this, but this is, in my view, personally, historically speaking, a bigger news story to watch as it relates to our money. I believe, one more thing before I go through our close up right here, and we're doing good. We're going to be closing in less than an hour, so I appreciate your time today. And then real estate itself. Real estate is sort of what we call in suspended animation. We've had some great years of real estate price increases, again, inflationary. And then you have a slowdown and a lot of uncertainty in the market. You have limited inventory still, but people now want to sell, but they want to get their neighbor's price from a year ago. Well, the market's slowing down, but also if you look at real estate as from an investor's perspective, the yield that you would get when you have, let's say, a $200,000 investment in real estate and you get a 5% return, that 5% is called the cap ratio, if you will. Okay. And so when that ratio, the cap ratio in real estate, or that income generated from that income generating property of an investment for you in real estate, when that's the same or close to in the same zip code as the 10-year treasury, which is the risk-free rate of return for investors, the investor is basically going to sit on their hands, put their money in the bank at 4.5% risk-free, and walk away. And that's where there's also competition for that money, if you will, or that investment opportunity for real estate. So something's got to give. We believe that, again, interest rates will come down and then you get that divergence. But right now, once you get the divergence, you'll see pickup in real estate. Okay. And then you're going to see a lot more people going after, again, limited inventory. So we could see a spike in home prices later down the road. Right now, real estate is a buyer's market. You could walk in and you could basically, do some really good negotiating. I would, when we're in this exact moment in time, because let's say you want to buy the house, don't worry about, you marry the home, you date the rate, right? If you're going to get a rate, a mortgage on the rate, you buy the house when you have limited competition and you as the buyer have all the leverage because someone basically wants to sell right now and they'll take, they'll be realistic. You'll find a good opportunity, but then you can a year from now, 2 years from now, refinance. In fact, a lot of lenders will allow you to do that for free, just to get you into the home for the first time and get that loan on the books for them. So you could refi for free on a lot of cases or limited fees. So if you're in the market for a home, now is a good time, I would suggest, because this won't last very long or too much longer. And that's why we're seeing suspended animation on the real estate side. all that competition for that money. So the good news is not being priced in. So right now we have tariff talks. They need to settle down, and we believe they will in the coming months. The tax bill, we believe we're going to see that tax bill in May or June. Sooner the better, and that will be positive for the markets, the economy, and for corporations, and the individual as well. And then the Fed policy, we believe we will see, because even the self-inflicted wounds or everyone just suspended animation slowing down, our business leaders not even making orders, if you will, because of the tariffs. The economy has slowed. We don't believe it's going to be a recession, but it definitely could be a soft landing. But we could, again, benefit later this year, or lower interest rates. So those three right now, we believe are not being priced in. Now, keep in mind, our process is to keep it balanced and diversified. As I said before, the art of asset allocation. We manage downside risk, win by not losing. And we also are staying nimble and putting money to work where there's some great investment opportunities. And trust me, there's some great opportunities out there. So we get kind of excited when we see quality on sale, if you will. And that's the time you want to be adding to your portfolios, not the time you want to be selling in your portfolio. So I think that's a good place to stop for today. I appreciate if you're with me for all of the hour. Wonderful. Again, please pass this along to somebody who could benefit. If you want to review or just to talk, we're here for you. But again, enjoy your day, and thank you for the opportunity for us to share our thoughts with you. Take care. We'll see you soon.
Blanke Schein Wealth Management is a group of investment professionals registered with HighTower Services, LLC, member FINRA and SIPC, and with HighTower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through HighTower Securities, LLC. Advisory services are offered through HighTower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other information contained in this research is provided as general market commentary. It does not constitute investment advice. Blanke Schein Wealth Management and HighTower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Blanke Schein Wealth Management and do not represent those of HighTower Advisors, LLC, or any of its affiliates.